I'm Greg Hunter. Welcome to USAWatchdog.com. Our next guest couldn't be on at a more opportune time. His name is James Turk at goldmoney.com, a gold expert extraordinaire. James Turk, thank you for joining us today on USAWatchdog.com.
Hi, Greg. It's always great to be with you.
And let me just set this up here for you. You have the Fed governor's Kashkari out recently saying that they're going to, in a speech, going to bail out the banks again. They're too big to fail. Going to bail them out again. You got all kinds of warnings about more QE and zero negative interest rates by the Fed and by the Bank of Japan and in Europe. And on Monday, when the markets had closed, everybody decides to sell their gold. It's so ridiculously manipulated. It's almost, I want to just laugh. It's comical. Who would sell their gold? And that little small, tiny thumbnail backdrop, who would sell their gold with negative interest rates on the horizon and more bank bailouts, according to the Federal Reserve?
And they would do it on a day that is illiquid because not only were the U.S. markets closed, here in Europe, or here in London, we have what's called half term, where everybody's on vacation in Switzerland skiing because the kids are out of school. So, it was obviously done to paint the tape. But the important thing is that, the underlying factors that why you want to own gold and silver, for that matter, have not changed. And what we have to do is look at the big picture and forget this day-to-day noise that can otherwise distract us from the major trends that are underlying the markets.
You are a gold expert, and I always say this about gold people because you can't just trade gold. When you're a gold expert, you have to be like Bruce Lee. You have to train every part of your body. You have to know all about economics and bonds and stocks and derivatives and everything. And you're over in that neck of the woods, and I want to talk about Deutsche Bank.
Yes.
Deutsche Bank is in deep trouble. It makes Lehman look like a small subsidiary bank in like Omaha. I mean, right?
Yeah, it's really quite alarming. The shares of the stock are basically where they were in the lows of 2008, at the bottom of that year's financial crisis. And here we haven't even started, the financial crisis yet, and the stock is back to those prices from 7-8 years ago. So it makes you wonder what is yet to come. And you're seeing all kinds of things like the publicity stunt, Jamie Dimon buying $25 million worth of shares of his stock. It reminds me of things that happened back in the 1930s when you read the history books of guys that went out and bought shares of stock to try to bolster their company and convince people that things are okay. But all you really have to do is look at what the market is telling us. The market is telling us that people want to be in safer things, and that's why it looks like gold's trend has finally turned after a 4-year correction, and it looks like we're going to be heading higher.
In your estimation, is Deutsche Bank in trouble? Are they going to send off a shockwave that will be, it'll be a daisy chain, a domino of defaults through France, through Spain, through Great Britain, all to America, to China, to Japan? If Deutsche Bank goes under, we're going to see like 10 Lehmans, aren't we?
Yeah, its derivative book is a huge problem, and few people are even talking about that. They're just looking at the loans that Deutsche Bank has to the oil industry, for example, and other sectors of the economy that are weak. Typically, Greg, when a bank like this is publicized, it's not always the one that goes first. It's often a surprise bank that can ultimately rock the boat. So you have to look at other places. You have to look, for example, at Italy. They have a huge non-performing loan problem. In other words, the debts that these banks have extended because of the poor economy there, the loans aren't getting repaid. So those loans are of questionable value. If they end up getting written off, the equity of most of these banks is just going to be wiped out. So you've got insolvency in a lot of different banks around the world. The difference is that these banks keep their doors open because they're liquid, and people basically aren't paying attention to how bad the banking situation is.
Do you think it could cause these illiquid banks could cause huge defaults around the world? Do you think that that's why they're coming up with negative interest rates? The Fed all of a sudden decided that we're not going to raise rates. We're thinking about negative interest rates because they could just take money to prop the banks up.
Yeah, and they're also talking about not raising interest rates anymore, as we go out toward the end of the year. And they're doing different things. They're taking they're using reverse repurchase agreements to finance all the government debt that the Federal Reserve has borrowed, rather than having the banks keep excess reserves in the Federal Reserve. So there are things that are taking place that suggest that, yes, maybe there are some liquidity constraints in the banking system, but we're also seeing it just in the debt markets as well. I mean, it's quite visible that the high yield market already exploded, but now we're starting to get into the investment grade levels as well, and there's a lack of liquidity in some of those investment grade bonds and corporate securities as well. So it's not just the banking system. It looks like we've got, every once in a while, every several years, we have these periodic crises because of the nature of this fragile banking system that we put together over hundreds of years, particularly since we abandoned, the discipline of sound money. But, we had the crisis in 2001, then we had the crisis in 2008, 2009. It's been another 7-8 years, so we're due for another crisis. And it looks like this year, next year, is going to be a repeat of what's happened previously.
The world has grown the debt, one figure, somewhere in the neighborhood of 57 to 60 trillion. Is it worse now than '08?
Yes, it is much worse now than '08. That's just the absolute debt amounts. That doesn't include the derivatives on top of the debt. And as we saw in '08, everybody thought derivatives were fine until Lehman Brothers was called to make good on some of the derivatives for which it was underwater, and it couldn't do it. So Goldman Sachs, AIG, was owed money by AIG and owed money by Lehman. They ended up getting bailed out with government money because AIG and Lehman couldn't deliver on their promises. So could that possibly happen to Deutsche Bank this time around, where somebody calls on derivatives where they want to collect the funds and Deutsche Bank isn't able to do it? Yes, but the point is that Deutsche Bank is much, much bigger and much more problematic than Lehman ever was. So given that fact, and given the fact that we have so much more debt and so much more derivatives in the system today than we did back in 2008, it's much more fragile now than it was back then.
Which leads me to my next question. You said earlier, and a lot of people want to hear this because I kind of wanted to set the stage of how shaky everything was in its debt. And the number one reason is there's just too much debt. There's too much debt in bonds and sovereigns and banks, and it's just derivatives, which is a debt instrument, basically. It's a debt. There's just too much debt. Okay, so now it leads us to your point that it looks like gold and silver have finally turned.
Yeah.
Explain that to people so they understand why, even though we have these up and down days, explain why you said it looks like gold and silver have finally turned. Why?
Yeah, it's not only just up and down days, but we have up and down months and up and down years. And what you really have to do to understand gold, you have to look at it not day by day, month by month, or even year by year. You have to look at it decade by decade. And ever since, the creation of the Federal Reserve back in 1913, when gold was $20.67 an ounce, the price of gold has gone up. It's not because gold is becoming more rare or more scarce or more valued or anything like that. It's because the purchasing power of the dollar has been going down for over 100 years. It's being debased, just like the Roman coins were debased for 100 years before that currency and economy finally collapsed. It's the same type of thing. So you have to look decade to decade over gold. Now, what we've been doing in gold within this long-term time frame, or within this long-term uptrend, of debasement of the dollar over so many years, you do have these cycles, as I was referring to earlier. We reached a peak of gold in 2011 when gold got up to $1,900 an ounce. We subsequently, over the last 4 years, had a pullback. Corrections occur, particularly corrections in gold when the government doesn't want gold to go running to the upside because it's a big red flag, showing everybody how many problems there are in today's monetary system.
Yeah, the government wants to commit, interventions and manipulations. Let's just say it, because that's what Monday was. It was an intervention or manipulation. It's comical to the point. Yeah. But anyway, I digress and I interrupt you. Go ahead and go to looking at gold in a longer-term picture, and that was a correction, yes?
And just make the point, though, that you're absolutely right. It's just like the manipulation that occurred in the 1960s by the cartel of central banks called the London Gold Pool. They kept gold at $35 an ounce for a long time, even though the market knew that gold was worth more than $35 an ounce, and people kept accumulating physical metal until eventually the central banks had to throw in the towel. And that, when they did, in March of 1968, that launched the bull market that lasted for the next 12 years, that took gold from $35 an ounce up to $850 an ounce. So again, it was one of those cycles. Now, what we've been in the last 4 years is a downward cycle, a correction in this long-term, multi-decade uptrend. And eventually, when prices get too cheap, when assets become too undervalued, the market doesn't like that. It doesn't like it when assets become overvalued. Money starts to move around from overvalued assets into undervalued assets. And what we've been seeing, particularly over the last year, a lot of money moving into physical gold. And ultimately, physical gold is what drives the price of gold.
Could the banks take and turn this around? I've heard reports of some of the big banks buying gold, buying silver, physical.
Yes.
Could the banks take and turn this around and say, okay, we're going to stop suppressing it. We need to make some money now. And jack it to the moon, just manipulate it to the upside, just like they've been suppressing it to the downside?
Yeah, it's entirely possible. In fact, if you look at what central banks are doing, you've basically got two sets of central banks. You've got the central banks that are in the U.S. orbit that have been saying nothing good about gold, have been basically dishoarding gold in a variety of different ways, trying to keep the gold price from rising to the upside. And then you have the central banks that are outside the U.S. orbit, like the Chinese central bank, the Russian central bank, and other central banks around the country of other countries, the central banks around the world of other countries that have been accumulating gold because they recognize what gold is. They recognize that it's the basis for any kind of sound monetary system. So what these countries are doing is they're playing the system as long as it exists, but they're preparing themselves for when the dollar eventually reaches the edge of the cliff and can no longer sustain a system that's sustainable.
You're saying that both sides of this game know there's a game going on, and one side says, okay, we're suppressing it, and the other side says, yeah, we know you're suppressing it, but we're going to get all we can get, so you keep suppressing it, and we're going to keep getting all we can get. Is that the game you're talking about?
Yeah, that's true, because these guys understand monetary history, they understand the value of gold, but for example, they don't want to be on in the West anyway, they'd want to be on the bridge when the ship of state goes down. So they're going to do everything within their power, to keep the system going. But, inevitably, what is unsustainable will end. And the amounts of debt that are being created, the debasement of the currencies that is occurring, things like negative interest rates are destroying capitalism. They're destroying the society that enabled us to raise our standards of living, for hundreds of years. And ultimately, that has to end. It's an aberration, and as a consequence, it's not sustainable.
Why are they shooting for? Is this a last ditch effort? Why are the banks shooting for negative interest rates? I mean, they're on a couple of continents. Negative interest rates. I think Sweden just went to negative interest rates. Germany's negative interest rates. Japan negative interest rates. Why is this crazy push for negative interest rates?
Yeah, it's the last thing that they're trying to do to keep the system alive before going to capital controls. I've seen estimates that there are about $7 trillion of government debt around the world that is now negative. In other words, you're paying the government to take your money, which is absolutely insane because it's just another type of taxation. And the other thing about negative interest rates, people always used to say, well, gold, you have to pay the storage fees, and that's like a negative interest rate. Well, the storage fees in gold are a lot less than the negative interest rates in a whole variety of different countries around the world.
I'll tell you, I want to have one last thing you're right about that. I want to bring up one last thing. Us in America, the Middle East is halfway around the world. To you guys in Europe, not so much. It's, it's within, rocket distance. It's what our Patriot missile batteries are supposedly to protect Europe. Supposedly there for. Are you worried about the situation in the Middle East where Turkey and Saudi Arabia are wanting to invade Syria, which of course Russia has troops, jets, tanks, and they're protecting Syria, and that getting way out of control, and the reason for that may be because the whole economy is getting ready to take a big fat dump, getting ready to go under?
Yeah, I do follow geopolitical trends and geopolitical issues to a certain extent because it does impact on gold and the gold market. And I must admit, what's going on in the Middle East is very worrying. I mean, this could accelerate into something worse. If you look at the developments over the past year or so, it's not getting better, it's getting worse. So the trend is moving in the wrong direction, and that's I think, reason for everybody to worry, regardless of which side of the Atlantic you're on. This is a problem the world is facing, not just Europe or not just America or not just Asia. It's a worldwide. It's a problem the world should be focusing on.
Do you think the powers that be are pushing this because they know the system is weak and may collapse again, and it might be a lovely diversion?
Yeah, a number of commentators have said that war is a good diversion. Unfortunately, that's probably true, but it's also quite tragic. And I hope that what's happening in the Middle East winds down peacefully rather than any kind of war. But given the things that we're seeing by world leaders today, anything is possible, including crazy outcomes. So we have to be prepared. And one of the best ways to be prepared, Greg, is to own physical gold and physical silver. Because in a world which is uncertain, where we cannot predict the future, you want to have diversification and you want to have stability. And gold comes to this day with a 5,000-year track record. It's been through wars, it's been through droughts, it's been through famines, it's been through everything, yet gold preserves value over long periods of time.
Silver investors are going to want you to talk a little bit about silver, and I did a quick thumbnail math problem at 1530 silver, divided it by $1,220, and I got almost 79 to 1 silver ratio. I think it's pretty close. It's in that neighborhood, 80 to 1. What does that tell you about the price of silver relative to the price of gold?
Silver is very, very cheap. And in fact, even though I'm very bullish on gold, I'm even more bullish on silver. If you look at it from this point of view, the geologists tell me that there's about 10 times more silver in the Earth's crust than there is gold. So logically, one would think that the price of silver would be 10 times the price of gold, but it's not. Like you say, it's 78, 79 times.
The price of gold would be 10 times the price of silver, only 10 times.
Yeah, the other way around. Yeah, it would take 10 ounces of silver to buy 1 ounce of gold.
Correct.
Yeah, thanks for correcting me. But it's not. It's way up there. Now, historically, the ratio is about 15 or 16 to 1, and that's because silver has two uses. It has a monetary use, and it also has an industrial use. So it's a contrast with gold, which is basically a pure monetary utility to it. Silver has this dual utility, and as a consequence, the ratio is slightly less than one would think, and the ratio can also be very volatile. Back in April of 2011, when silver last reached $50 an ounce, the ratio was about 31. Today, it's like you say, 78. So going forward, my expectation is that that ratio is going to fall, which means that in dollar terms, silver is going to outperform gold going forward. The point, though, that is important to make is that silver is a little bit more risky than gold because silver does have that volatility. So you have to be able to handle that volatility at silver that you don't necessarily see with gold. So generally what I recommend is if you want silver in your portfolio, do about 2/3 gold and 1/3 silver. And when the ratio is finally aligned to a more normal level, you'll have more silver than you will gold when measured in dollar terms.
Excellent, my friend. James Turk, goldmoney.com, goldmoney.com. Anything you want to announce, anything that you have that you'd like to talk about, just one of your pet things or that you want to get in?
Well, in terms of pet things I want to mention, I think I've already mentioned it before, but I can't stress the importance of it. There's a difference between physical gold and physical silver and paper gold and paper silver. When you own futures, when you own options, or even when you own an ETF, you don't own gold or you don't own silver, you own shares of the company. If we are looking to buy gold or silver because it's a safe haven, and that's one of its major utilities, you want the physical stuff, you don't want the paper stuff, and I would just leave that as an important thought for everybody to consider if they are planning to enter into the gold and silver market.
And before the end of the year, I'm gonna put you on the spot here. Do you think prices of gold and silver will both be higher? I mean, that's a puffball question. I don't know. I mean, it seems to me it will be, but I don't know. I'm not an expert. What do you think the odds of gold and silver being much higher before we see 2017?
Yeah, I think the odds are pretty good. But, if you look at the last 15 years, gold has gone up in dollar terms by more than 10% per annum on average. It's had, of 15 years, I think, 12 up years and 3 down years or something like that. I can't remember now. So the odds are that this is going to be an up year because we're coming off of a couple of down years. And we know that gold is undervalued, so I think we should look at much higher prices. But keep in mind, gold is not really it's something that's going to create wealth in a macro sense. It creates wealth for you if the price goes up because what's happening is the wealth has already been created. It's in the form of purchasing power that somebody's holding in a national currency. So if the price of gold goes up in terms of that national currency, you're basically taking purchasing power away from the guy who holds that national currency and giving it to you. But in a macro sense, there's no wealth being created. It's just being redistributed. So, a stack of gold bars is no different than a stack of $100 bills. It doesn't create wealth until you go out and spend it or, create it and make an investment with it. What gold does much better than a stack of $100 bills is preserve that purchasing power over long periods of time.
In short, with a very shaky economic system and geopolitical system, just not losing is winning. Not losing is winning.
Yeah, in the environment that we're in, with all kinds of crazy things going out, if we come out the other side of the valley, as good in terms of our wealth as we went into this uncertain period, we're going to be doing very, very well. I would expect to see a lot of wealth destruction. But, at the end of the day, Greg, the houses are still going to be there. The farmland is still going to be there. The timberland is still going to be there. The oil wells are still going to be there. The bars of gold and silver are still going to be there. It's the paper assets that are going to evaporate. And I think paper currency purchasing power is going to evaporate along with those paper assets.
Very good. Thank you very much. James Turk, goldmoney.com. What a great way to end that. A great time to have you on. Thanks for coming on and being our nice, calming, soothing, babbling brook of beautiful sounds of hey, this is what you got to do. And I don't mean you babbling brook. I mean just nice.
Yeah.
You'd like.
I understand exactly what you mean. I've been around a long time.
A nice calming voice. You're not ranting or gold's going to the moon. I mean, you're just saying
it comes to have. The calm voice comes with the gray hair. I've seen a lot of it.
A nice calming voice. A nice. That makes people know the truth when they hear it. They know it. They know when somebody's sitting there lying. It's weird about the internet and TV. And when you listen to you, I think that's the truth. People know the truth when they hear it. So thank you for coming on and giving us the truth, James Turk of goldmoney.com.
Thank you, Greg. Always great to be with you.